It's cheaper than operating a subsidiary, but you're going to have to buy that percentage maybe at a premium to the market value. It's kind of a old thing, but just because it's here, we can do it. The so-called Edge Act banks, they are federally charged subsidiaries of U.S. banks that are physically located in U.S., but they can provide a lot of international services. Sometimes you just want to do offshore stuff. If you go to Cayman Islands or Bahamas, there are these buildings where there are long corridors and all sorts of little nameplates. I mean, they all have the same address. It's an offshore banking center. I mean, they're subject to regulations of that. There are certain things you can do in those offshore banking centers that are much cheaper to do. I'll give you an example. And this example technically has nothing to do with international banking, or actually it could. Let's say I'm a I'm an investment bank. Uh, I'm a branch of an investment bank that operates in London. I worked in such an American investment bank back in 97, 98. And it was called Donaldson, Lufkin and Jenrette. We were in the London office. Certain products that you have requires you to issue a bond. Example, we had a product that did the following. It was called a senior junior bond. I'm going to issue a bond uh, where the returns depend upon the value of a US dollar denominated bond issued by the government of Turkey. Okay. I'm going to do two tranches on it. One is called, let's say, $100 million worth of stuff. One is called the senior tranche. The other is called the junior tranche. If somehow uh, the Turkish government has problems making the payments on this, the senior branch gets paid first, then the junior tranche gets paid. So let's say that month the interest payment is $10 million, and Turkish government said, sorry guys, we're in a tough situation. I'm going to pay you guys only five. All of that five is going to go to senior tranche, depending upon the percentages. Let's say I did 80-20 senior junior. But if $9 million came in, 8 goes to senior. The junior guys, even though they're promised 2, they get only 1. Of course, the juniors are a lot riskier, hence they have higher returns. There's a reasoning behind this, but I need to issue 2 bonds. Okay? Doing all of that in the US regulatorily is very immoral. So you go ahead and issue this bond in Cayman Islands. And then you sell these bonds to your clients and they pay you. I mean, they're still your obligations, but they're not US bonds. So offshore banking centers are actually rather useful for this sort of stuff, but they could also be useful for other services. And US actually kind of limits what US citizens can do with the offshore products like those, primarily to eliminate or limit money laundering activities. Okay. There's also so-called international banking facilities. Uh, the purpose of this is to segregate the accounts of the international banking facilities and the parent bank. Example, going back to that example, senior junior tranche. Suppose I'm going to do $100 million worth of Turkish euro bonds. I'm going to establish, we usually call these in other cases, a special purpose vehicle. That special purpose vehicle could be in Cayman Islands, Bermuda, Anguilla, I don't know, whatever you want. You can have it in Eswatini if you want, if the regulations allow it. And this bank, this facility actually buys those bonds, $100 million of Turkish bonds. Then they issue the senior, junior branches. The office in London sells them to clients, and the money that comes from those sales goes to international banking facility to pay for the original purchase of the bonds. So, in a sense, this is the asset-backed security. It's backed by the purchase of those bonds. But if something happens, these guys cannot come after the parent company because the balance sheets books are separate. So if they have a beef, they're going to go to the IBF. They're going to settle it there. It's rather convenient given the cost of litigation in the United States, and they're rather useful. And you can also have deposits over here, and typically those deposits have higher rates of return. Why? They don't have to go through the US regulations. You know, if I have $50 billion worth of deposits in an international banking facility, that doesn't count as a parent company towards my capital adequacy ratios. And the assets I buy with that doesn't count towards that. So it's kind of potentially run around the capital restrictions in US banking system. Talking about that, regardless of where you are, except some really in the middle of nowhere countries, there are serious capital adequacy standards in international banking, in any banking. I mean, I don't want to say anything about Burkina Faso. The old name is Upper Volta, which is an old French colony. But more than likely, even if they have capital adequacy ratios, given the political corruption, it probably doesn't mean anything. Let's think about banking as a business. In banking, you make money using other people's money, right? You have your own capital, money that you have invested into the bank, but you also collect deposits and some other sort of funding, and you use those to make loans or investments into other assets. So if, when I borrow from Chase or JP Morgan Chase, I got mortgage, they lend me $500,000. Where's that money coming from? Well, it's coming from either from the capital of the bank or from their own deposits. Since banks are in the business of borrowing at a low rate and lending it at a higher rate, To the extent they could, they want to use other people's money. But that creates a problem. Let's go to the example of you guys remember Silicon Valley Bank? Hmm?